Okay, hello and welcome to LiveSquawk's Market Talk. If you missed the start of today's episode, by the way, you can listen back on the likes of X or YouTube, or you can find us on podcast platforms such as Spotify, Amazon Music, as well as other places. Hello and happy Friday, 2nd of May. Today we'll take a look at the US non-farm payrolls, and then we'll move on to reviewing key highlights from the past week. I'm joined by two guests who have been on the show before. Gunter Grimm, strategist and trader, 25 years plus within the foreign exchange, fixed income, macro and quant world. And Sam Cutler, portfolio manager at 333 Capital. Hello, guys.
Hey, Harry. Thanks for having us back on.
Thanks a lot. Awesome. Before we get into that, though, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, again, I'd like to bring in my two guests. Before I do that, though, I just want to quickly preview today's number. As I said, we do have non-farm payrolls. I think the consensus at the moment is around 133,000 for April, which would take it down sharply from last month's 228,000. Previous month's data has shown downward revisions. January was lowered by 18,000 jobs and February by 34,000. And this prompted expectations that March's figure may also be marked down amid growing economic uncertainty linked to tariffs. For those on social media, you'd also be able to get there's a table that we push out every month that gives you the median estimate as well as what the major banks are saying. So it gives you a bit of a range as to what the experts are saying. To get back to today's number, then just a quick note here from Deutsche Bank on the number is out at 12:30 GMT, 8:30 Eastern time for those new to this. Deutsche Bank, they forecast a headline number of 125,000. That's versus 228, as mentioned. They see private payrolls to come in at 125,000 versus 209,000. They say payroll forecast reflects payback from strong March hiring, particularly within the leisure and hospitality and retail sectors. Recall that signal from non-farm payroll gains tends to get modelled in March and April due to the shifting Easter holidays and spring break dates for schools, as well as weather factors that can all impact early spring hiring. Despite the expected downshift, the unemployment rate should remain unchanged at 4.2%. And with that, I'll bring in my guests. I'll start with Sam. Sam, any views on today's number before we expand on the wider connotations?
Yeah, so I mean, I'm a little higher than the consensus here. I still think it's going to be a little lower than the previous print, but I still think we're looking at a pretty robust number here. Estimates probably for myself within the 150 to 180K range. And a lot of that is going to be coming from gains concentrated in construction. We should see, like you mentioned there, some pullbacks in transportation and logistics and the leisure and hospitality, with those being so strong in the previous print. But this deceleration really should kind of come as a combo of the tariff announcement and the pullback in discretionary service spending. And again, like the government headwinds, right, from this hiring freeze, it's very difficult to forecast these implications, but I do think they're going to start having a negative effect moving forward, right? We've seen a pretty large deterioration of jobs hard to get versus jobs plentiful on the differential. And there's also been a very sharp deterioration on the 6-month outlook for jobs. So again, this kind of goes to show with what we've spoken about before, that the soft data has rolled over meaningfully, right? If you look at some of the other data from this week and last, the Conference Board consumer sentiment, right? Those expectations fell I think it was roughly 12 points in a single month. The U.S. Empire Manufacturing new orders 6 months out posted negative 6.6. The only other times this thing printed negative was once in late 2022, then in 08 and 09, and in 2000, 2001. So it's kind of shows the meaningful rollover here in soft data. So now I think we're just really waiting to see if kind of hard data catches up to it, which I think it will. And I think this is going to be one of our last stronger payroll prints before we kind of start to post some much, much lower numbers, probably sub that 100K area. And I really think it's the private sector that shows some importance, because if you adjust Challenger layoff announcement data for the government jobs, you find that private sector layoffs have been around 100K, and it's been around this 100K the last 3 months, whereas in the previous trends, it's been closer to about 50K, right? And we did see a bounce in hiring announcements, but that was really due to a 12K job announcement in the insurance sector, which this has been around 0 for the past 6 months. So otherwise, we're really not seeing any hiring at all in the private sector.
Okay, interesting. Well, thank you for picking up on the private payrolls element of this. Gunther, do you have any views on today's number?
Hi there. Not really on today's. I've kind of given up trying to forecast payrolls on a month-on-month basis. I've tried some modeling, but was never really successful. I try to look at the trend, and as Sam rightly said, there are some worrying signs towards maybe a potential weaker labor market going forward. Sam mentioned the labor market differential. Also, wage growth is slowing down, and we have a lot of uncertainty. So probably corporates will be very reluctant to hire in this new trade tariff environment. Here, right. The trade policy uncertainty index from Goldman's, the chart. So I think I would not put it this way. I would not be surprised to see a downside surprise at some stage. Maybe it's too early, a bit too early for this month or last month's number, but maybe looking forward, I would not be surprised to see weaker numbers, which has then, of course, implications for the Fed. Waller recently said that he's ready to cut once the labor market deteriorates significantly. And the inflation outlook, apart from the tariff...
Sorry, and just to quickly interject, Waller, who's been more on the hawkish side of the argument.
Correctly.
Which is why it's more significant that he, that he says something dovish.
Absolutely. He's changed his tone. Some people suspect he wants to become the next Fed chair, might be. It's notable that he's turned very, very dovish, and he's concerned, or he would not be surprised, I guess, if the labor market deteriorates, and then would be quick to act. Coming to the Fed, we have these rate expectations here from the CME tool, and over the course of a year or so, a bit longer, we have more than 100 basis points priced in. I would not be surprised if the data comes in weaker at some stage, if they push or pull forward their rate cuts, the Fed, that is. And although you might think 125 basis points is a decent amount of rate cuts currently priced in, I would look at the profile. Maybe we shift that a bit, pull that forward a bit towards this direction.
So basically, I mean, we'll come back to the Fed in a minute, because the Fed meeting, by the way, is the 6th and 7th of May. So that's next week. We'll have a show previewing that. But just to bring it back to what we're likely to see then over the next few months, a weakening job environment, really. And we're coming to Trump's first 100 days and maybe the next 100 days of what we're likely to see from the US president in his second term. But in terms of how impactful what we've seen so far is on this jobs market, has it just hastened what was already likely to happen in terms of a reduction in jobs and a rise in unemployment? I mean, we were all, I think, a year ago factoring in, well, not all of us, but factoring in a recession for the US economy anyway, and that would have, on the back of a looser job environment out there. Has it just hastened that inevitability, basically, Sam?
I think it's really just it's sped up the process a little bit, right? And there's one thing I'm still torn between, is whether we are actually going to see material layoffs or if we're just going to see more of a hiring freeze, right? I think that's going to be very dependent on what, I hate to say, but what ultimately happens with these tariffs, right? Because I still feel like it's up in the air from day to day. One thing's being said, the next day something else is being said. There's deals on the tables. They're talking to people. It's when is something material going to happen, right? And I think that's going to be a very key factor in the speed at which this potential, recession or downturn comes, right? I think it's very clear that we're going to likely get a technical recession. I think it's going to be very easy to get 2 consecutive quarters of negative GDP growth. But how deep is that recession going to be, I think is going to be very dependent on the tariff path.
Okay. You mentioned growth, so we might as well take a look at that. We saw Q1 GDP flash estimate come through on Wednesday, it was now. So, and it was, I wouldn't say grave reading because that would be over dramatizing it, but we had a negative print, minus 0.3 for growth, and on a quarterly basis, which was slightly below estimates by about 1/10 from most medium forecasts. So not an absolute surprise, but worrying in any way, Gunther, do you think?
Well, I think the economy was already slowing down, and I think what many people missed, me included, was that the fiscal stimulus we had in the Biden years had still a positive spillover effect, and therefore this recession, which many people, as you rightly said, anticipated, never really happened. But that is now fading, and now it depends if these these tax cuts Trump at the time implemented will be extended. But I'm not sure if we see from a delta perspective, such a big new fiscal stimulus. So maybe we stay at a high level, looking at the budget deficit of GDP, that we might stay at around 6% or so. But there are also some voices within the Republican Party who want to cut spending. So we have to wait and see what the spending bill at the end will look like. And now we have this trade tariff uncertainty, and I agree with Sam that every day we can have a new message. Now it seems that they're talking, but I kind of fear that the damage is done. You see that in the freight business where people don't order anymore and ships are being returned, and in the ports there's less turnover. So that will have ramifications for the trucking sector and for the port sector, of course. And I expect some layoffs there. So it really is a stagflationary scenario for the time being.
Okay, Sam, you're of the same mind?
Yeah, I agree with Gunther there. I think the damage is done. How do you bring back certainty, right? When you've caused so much uncertainty, it's not going to change it in a drop of a dime like that. It's going to take some time, and like you said, the damage is more than likely done. And you kind of see that with the GDP print, right? Because GDP was really driven by the surge in imports, right? So you can kind of factor that this was all ahead of tariffs, right? The whole imports took off 4.83% from top line GDP growth. Still, if you look at the private domestic demand, it held up decently, and that was boosted by stronger business investment. Inventories, they had the strongest contribution in over 2 years. This was from, business stockpiled inventories of imported goods. That added 2.25% of growth to the top line. So I think that just shows that so much of that data was driven by kind of tariff uncertainty. So I really will be curious, and it's a little ways out, but on the next GDP print, are we going to get some give back on that if we do get some clarity on the tariff front? And maybe that'll give us a little indication of what we just spoke about. Is the damage done from the uncertainty standpoint there, or is there still more to come?
Yeah. Just on the GDP print as well, we did see consumer costs start to pick up a bit on the read. The personal consumption expenditure deflator rose 3.6% on a quarterly basis compared to 2.4 in Q4. Obviously, this is backward-looking data. We've started seeing maybe a little bit of softening on the prices front, as well as we see a slowdown start to impact activity. The core measure on the quarterly read, which excludes food and energy, was up 3.5%. That was 0.4 of a percentage point above consensus. But again, that was on the quarterly read. We take a look at the actual monthly data from March, and I think that was a slightly better gave a slightly better read, really, where prices, core PC prices, were up 2.6 annually in the month of March. So some mixed prices data there. If you look at the wage data for today, or the expectations for today's non-farm payroll, and we're looking at 0.3% on the month, 3.9% on year-over-year. That's slightly touched down on that annual read from the 4% estimates we were seeing and print. So for wages, are we starting to look for that to be impacted a bit more on here now, or do you think they'll remain elevated at the moment while they retain, if as you say, we're retaining staff and just hiring freeze at the moment, you pay the guys you have there more because you're not spending money on new recruits. Sam, is that a fair assumption?
I would say so, and I'd like to point out too, like a big cause of that employment cost jump was in the healthcare sector. That was 1.3% alone from under 0.8% in the previous print.
Okay, understood.
So there's a lot of weird seasonality stuff that still goes into there. And just to point out some of the seasonality things too, if you look at claims yesterday, right, there was a big uptick in claims, and that was all mainly coming from New York City region. Those were up 15K alone, and it sounds funny to say, but it was also spring break week, right? Yep. And I don't know if you're aware, but school bus drivers can collect unemployment during spring break week.
Did not know that.
Yeah, so it's a very similar thing that happened as last year, and you'd think, seasonal adjustments would be able to capture this, but because spring break week is never the same, it's unable to be captured in those standard NSA models.
Good insight.
So there's just a lot of weird seasonal stuff that factors into that stuff as well.
Again, cloud is the waters a little bit there as well. Exactly. I want to turn to President Trump, and this is probably been covered infinitum, but these first 100 days came past this week. I just want to put a little bit out there from Julius Baer, who've put a note out. They say the honeymoon period of the new US administration concludes this week, but the first 100 days of Trump 2.0 have felt more like War of the Roses to anyone outside of the Oval Office. As the first 100 days of the new administration come to a close, they recap their changes in forecasts, and they make some key takeaways. They say Trump policies have reversed US exceptionalism altogether. As a result, growth prospects have almost halved for the US since mid-January, and recession risks have now tripled to 50%. In currencies, dollar forecasts have been slashed by more than 10%, while both the Japanese yen and Swiss franc have benefited significantly from the tariff risks. As the domestic recovery remains fragile and external tariff shock drastically increases growth risks, we expect the Chinese government to step up its support measures to stabilize the economy. For investors, the mantra remains to reduce US assets in rebounds and add European and Chinese assets during the weakness. So I guess the damage, like you say, has already been done in growth terms. But Gunther, as a non-North American there, how much reputational damage has been done to US assets, in your opinion?
I think quite a lot, and I think the turning point was really the session in the Oval Office with Zelensky, Vance, and Trump, and that opened a lot of eyes here in Europe. People were actually quite shocked, and you saw it already with the German new chancellor. He said, "Okay, we have to rethink our alliance with the US, and we have to become more independent. Europe, that is." Rightly so. And I think now these fund managers here in Europe who have in the last 10 years or so invested a lot of money in the US asset markets have to rethink. They are like a super tanker. When they change course, it will be very slowly. They have meeting after meeting. But you see that in the price action that it happens. Today, for example, the dollar all of a sudden falls out of bed. So maybe these reallocation shifts take place, leading to some major moves, and I would expect that to continue. And let's also not forget, in the good old days, you would say, don't fight the Fed. At the moment, I would say, don't fight Trump. Trump wants a weaker dollar. That's my main investment theme, and he will get it somehow. Okay. And, so that I would expect these trends to continue.
Okay. Sam, any views on this?
Yeah, well, I mean, I'm kind of the opinion that equity performance has kind of shifted, let's say, from monetary policy driven to definitely in the past few years more fiscal drives equity returns. And I think it's made very clear that Trump wants to, kind of rein in the fiscal. And now you have other parts of the world starting to really want to engage in more fiscal. You have Germany, you have Canada starting to step up, I guess their fiscal, right? So I think you are going to see some other aspects of the world start to outperform the U.S., and I think that could continue on for a while. Also, kind of with all that uncertainty that Gunter spoke about too.
So this is we are looking at tectonic shifts in not just investment and in assets, but generally speaking, and it's a designed and desired effect from the Trump presidency for this to happen. I mean, like you say, he wants a weaker dollar, and that comes as that there are ramifications for that if he wants that to be the case. Do you think he's overstepped it a little bit? Do you think some of this was unintentional in terms of his actions, or was this all mostly by design? Well, he might want to say it's all by design, but there are things outside of his control. You don't want to start seeing the treasuries, I guess, lose that. And I don't, like you say, this is a long-term process, and these things turn like big oil tankers. That doesn't happen overnight. But do you think there's this chipping away then of the US Treasury? Do you think there's further stuff to come in terms of the weakness in auctions from overseas buyers and all this sort of process? Do you think that continues then in the foreseeable future, Gunther?
I certainly can see the risk. I mean, he wants to have it all. He wants low interest rates. He wants a weak dollar. He wants lower inflation, but at the same time puts tariffs up. I don't know how he can square the circle. At the moment, he gets a weaker dollar. At some stage, if the data stabilizes, the bond market will take note, or might already take note soon. So I fear the EMification of the dollar. That's my risk scenario. So you see days like falling bond prices, falling stock prices, and a falling dollar. That's typical for an emerging market. And we've seen already a few periods of that happening, and might happen more often in the future.
Okay, fair enough. Sam?
Yeah, I mean, I think the risks are there for sure. I don't think we're seeing that yet. If you look at some of the previous auctions, as far as treasuries go, there's still very strong international demand for them. I think it's going to take a lot more for, to lose that international demand. But with Trump, it's a wild card. He could say something, do something that's going to cause them to not do it, right? Like, I'm surprised that China has still been a purchaser of bonds, right? You'd think that would be a negotiation tactic, would be to stop their purchases, or even to sell some of their treasury holdings and move that, into gold, which I honestly thought was happening until I went through the data of the treasury auctions and saw that, international buying hadn't really changed at all. So it kind of just nixed that thesis for me.
Well, I mean, it's funny because everyone's been watching these US more than normal, watching the US auctions, and there hasn't been this predicted cataclysmic event of buyer strikes from foreigners at least, and maybe the Chinese are playing the the grown up in the room and know that it would hurt them, or it would harm their asset, really, in their portfolio more than needs to be done at the moment if there are discussions. And maybe that bodes well for the ongoing sort of behind the scene discussions that we're led to believe are happening at the moment between the Chinese and the US. So we can probably take that as a positive at the moment, that things aren't going to get too out of hand too quickly. But like you say, we don't know from one day to the next, let alone 1 week to the next. I just want to quickly finish up before we wrap up today on the FOMC next week. We'll have a preview show in more detail for FOMC, but we're looking at the moment. There's no change expected, but economic uncertainty is on the rise, as we know. The Fed is likely to want more clarity on data to come through, so that could be one reason why we stay at this meeting. Also, the worries about igniting an inflationary picture at the moment. If we've currently got stagflation, we've got the prices where they are, but growth is starting to stall. Do you really want to start bringing another factor into the mix at the moment, I guess, from that as well? Just very quickly then, guys. Sam, you can go first on this one. You expecting much from next week's FOMC?
No, I think it's going to be very much of a non-event. Like you said, they're kind of still, I think, in wait and see mode. They're going to want to see the impacts of tariffs on inflation. I think there's going to be a modest jump in inflation on those tariffs. It's going to prove to be temporary because, if tariffs stay implemented at these high rates for too long, that, ultimately leads to a deterioration of growth. I think for the Fed to cut interest rates, we're going to need a couple months of pretty bad non-farm payrolls prints, and we're going to need to get a couple data prints of inflation out. So I really don't think there's going to be any moves in the Fed till, I'm going to say, at least, July. And I do see a scenario where they kind of still just continue to hold steady and maybe only cut towards the end of the year.
Fair enough. And Gunther?
Can I answer this question after the NFP report? No, just kidding. No, I think Sam is right. But let's say that if there's, for example, a negative print, which is statistically possible, you have a high standard error around these estimates. So
yeah.
Then I think people who are on the edge of cutting will be more vocal potentially, like a Waller guy, for example.
Fair enough. Thank you. Right. I just want to then wrap up and say, for anyone who's missed the start of this show, you can go back and listen to it on X or YouTube right now, or you can listen to it later on at your own leisure on any of the podcast channels, Spotify, Amazon Music, amongst others. And just to finish, just to quickly remind you, we have non-farm payroll in today, 8:30 Eastern Summer Time. 12:30 GMT. We're looking for around 135,000 for the jobs number. And quickly, there is a chart up on our social media platforms, if not on the website. You can see that gives you just all the major banks' estimates for that. I'd like to thank my two guests for their input today. Sam, thank you very much. I know you've been battling an illness, so I really appreciate you coming on today.
Thanks, Harry. Appreciate it. Hopefully, we're on the upside of it now.
Good. We'll get well soon. And Gunther, thank you again for your contribution.
Thanks a lot, and thanks for your squawk, Harry. Much appreciated.
Thank you very much. Mention the squawk. Anyone who wants to listen into today's non-farm, you can go and trial LiveSquawk.com and get a trial out and see if it's something that may help your trading generally or your news gathering particularly. And with that, I'd like to thank you all for listening, and we'll see you again for next week's FOMC preview. Thank you very much, and goodbye.
Good luck, everyone. Bye-bye.
Guys, see ya.